Good morning, everyone. This is John Thomas, the Mad Hedge Fund Trader, broadcasting to you live from Silicon Valley, California. And after this webinar, I will be of Lake Tahoe, Nevada, as fast as my Tesla can get me there. Why listen to me? Well, 50 years of experience in the global financial markets helps. I spent 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, little brief vacation as a Marine combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund. Then I spent 5 years fracking for natural gas in Texas, still have oil under my fingernails from that one. And now it's 11 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working and still breathing, for that matter. The other reason to listen to me is performance. We have made money every month for the last 18 months, except for November, where we had a small dip when we got the second leg of the meltdown. Key to this success, stop out of losers very quickly. Only 10% of our trades are losers, 90% are winners. That doesn't happen very often, but it's easier to dig yourself out of a small hole than a big hole. Our 2018 year-to-date performance is up 29.76. That's compared to a Dow that's now down 2.6% on the year. Trailing one-year return is 35.33% versus 305% for the entire 9-year track record of the Trade Alert service. That brings our average annualized return to 34.36%. Yes, that's what we've made every year for the last 9 years. Let me pay for your Christmas. After losing $2 trillion in market value in 2 months, stocks look to make back much of that by the end of the year, and I'll tell you why. An onslaught of positives are about to hit the stock market. Yes, I know it's hard to believe, but we have been showered with negative news for 11 weeks now. That is about to come to an abrupt end. For a start, markets have risen an average of 14.5% in the 1 year after every midterm election since 1946. If you bought the midterm election, you made that much money in the following 12 months. This year will be no different, except that we have a lot more reasons why you'll get these outstanding returns in the coming 12 months. Who won the midterm elections? Who cares? You won the midterm elections because the market is loading up with some very unreal opportunities and some very easy plays heading into year end. The mere passage of the midterm elections is far more important than the actual outcome because it removed a huge uncertainty and unleashed a mountain of cash into stocks. It's been holding market backs for 9 months, no more. Window dressing is always a big issue at the end of every year. Hedge funds and mutual fund losers will window dress their year-end accounts to maximize their performance for marketing purposes. That means buying more winners and chucking out the losers. So buy the top performing shares of 2018. They will go higher. Managers will also ditch their worst performers to enhance the return for marketing purposes. And take a look at U.S. Steel, the car industry, the real estate industry, and banking. These have been the disaster sectors of 2018. If you notice in the last week, they really have accelerated their downturns. This is the reason. Seasonality is always important. Almost all the stock gains since 1946 have been during the November to May period. Hint, hint, it's December. We're in that period of outperformance. So remember, sell in May, go away. Buy in November and hang on for dear life is the flip side of that. So stick to the end of this webinar. I'll give you a couple of classic trades and I'll give you a trade alert which you can execute at the Monday morning opening. Tax loss selling. Sell stocks now and taxes on capital gains are due in 4 months. Sell stocks in the beginning of January and those taxes are not due for 16 months. This creates a seller's strike at the end of December and acts as a boost for all other share price influences. Biggest beneficiaries will be, again, the stocks that have gone up the most, like Amazon and Microsoft. Share buybacks are another stock supercharger. $200 billion has to be spent by the end of 2018. Technology companies like Apple, Google, and Microsoft are spinning off profits so fast they are creating massive cash balances. Most prefer organic growth, so the money isn't wasted on takeovers. Dividend demands of low interest rates are minimal, so there's nothing else to buy back but your own shares. Buybacks will rise from $500 billion in 2017 to $1 trillion this year and another $1 trillion in 2019, with 75% of those buybacks taking place in tech. Yes, 2019 could be an all buyback year. Apple alone plans to buy back $125 billion worth of its own stock. Yes, that makes Apple screaming buy right here at $165 a share. When the supply of a stock falls, the price can only go up. That is what's going to happen. Hedge funds have big short positions. Those have to be covered by the end of the year so they can get performances bonuses based on those profits. We cover several of the largest hedge funds in the world, so we know how they're positioned. We're advising them what to do next. Big hedge funds are currently running massive short positions. These all have to be closed by year end. The stocks that have seen the largest falls, like big tech, will see the largest number of buyers going into the year end. Hint, hint, Apple is one of those. Target those stocks for buys like I am. Oil prices. You may not have known that the price of oil has dropped 35% in the last 2 months because it hasn't shown up at your local gas station yet, but it will. This amounts to a $200 billion economic stimulus for the U.S. economy. That's how much our energy price bill will get cut. Big energy consumers like transportation stocks will be the biggest beneficiaries. Oil bottoming here makes oil companies like Chevron and ExxonMobil a great buy. What is the smart money doing now? Yeah, I get asked that question every day. Focusing on the highest quality earnings growth name with the biggest falls, hedging out downside risks for the short term, avoiding the banks, buying gold on dips for a return of inflation in 2019, and avoiding strong dollar plays like emerging markets and commodities. And if you're wondering why I'm in such a good mood in this particular picture, it's because I'm flying a P-51 Mustang. That's a World War II fighter. If you don't know what a P-51 Mustang is, that's it. Usually I get around to flying one of these once a year, usually when I'm in Florida, where there are a couple of them where you can rent for $10,000 an hour. When I get tired of flying my P-51 Mustangs, I go fly British Spitfires. This is one flying off the White Cliffs of Dover. Much more difficult plane to fly. There are far fewer of them, but believe me, it's worth it. Global liquidity is still surging. 10 trillion in global liquidity has been created by central banks since 2008. Even though new money creation is slowing, what has already been printed is still out there. There is now 50 trillion in cash deposits around the world looking for a home, and some of those estimates go as high as $100 trillion. Most of the private and public debt in Japan is now government-owned, meaning those countries have no net debt at all, unlike our government, where we still owe $21 trillion. So there's nowhere for the money to go but stocks with real interest rates at zero. When I say real, that means the overnight rate minus the inflation rate, and that gets you a zero or even a negative number. U.S. tech stocks are target number one because that's where the earnings are. This is the secret to our success. It's the Mad Hedge Profit Predictor. This is a market timing index that analyzes 30 different economic, technical, and momentum-driven indicators 24 hours a day, 7 days a week. The rating we had at the close on Friday was 8. That puts it into extreme buy territory, and it's one of the lowest readings we've had in the 30 years of tracking this index. To see how it's done over the last couple of years, hang on. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. Approximately 80% of all trading in the market now is algorithm driven. It runs real-time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that updates itself 30 times a day. That's what we have. Don't go to a gunfight with a knife. If you are trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. Here's 3 years of profit predictor performance, and as you see, whenever we get extreme oversold market conditions, it spits out a buy signal. When it gets overbought to the upside, when we get readings around the 80 level, which is where we were in September, it gives a very strong sell. And notice we get several round trips a year, plenty of opportunities to trade from both the short side and the long side. Just to show you how our performance has measured compared to the S&P 500. Yes, anybody can make money in a bull market, but we don't always have bull markets. In the last 3 years, the S&P 500 has risen 59.44%. Our performance at Mad Hedge Fund Trader has increased by 113.77%. That's double the SPY performance with less volatility. Notice that this is a typical hedge fund type performance. We get sharp up moves followed by sideways moves, followed by sharp up moves, followed by sideways moves. In the real market, you're going like this, driving people crazy, forcing them to stop out of their losses at the bottom and then rush in to buy back at the tops. It's a perfect money destruction machine if you're relying on your own devices and don't have 50 years of experience. You might even pass with 40 years of experience. S&P 500, this is the chart as of the Friday close. We got a very strong sell at the end of September, went short there. We are now buying the dip. We think we're a couple of bucks within low for the entire down cycle, and after that, it's off to the races. Watch out for the head and shoulders setup in 2019. This is our longer term view. We think we're putting in the final head and shoulders on the entire 10-year bull market. We got the left shoulder there in February. We got the head at the end of September. And we've got this big dip here, which allows a setup going into March 2019 of a right shoulder. That is when we think the new bear market in stocks begins. So this is a market you want to date but not marry. You can make big money over the next 4 months, just as long as you remember to get out when the music stops playing. Microsoft, this is the signals we've gotten from Microsoft over the last year from our market timing index, and we got a very strong buy at the February lows. Ran it all year from 82 up to 115. Took profits here but never went short because we love the long-term fundamentals of the company. We're now diving back into this stock every time it dips down to 100. Now is where you want to start buying back this stock. Long term, and when I say long term, I say a year or more, we expect this stock to double from the current level. Yeah, Microsoft is taking over the cloud business from Amazon, and he who owns the cloud owns the world. Facebook, we played Facebook as long as it was alive and healthy going up into the end of July. We got out at the top. We actually sold at about $200. Missed the entire meltdown. Now we're still saying to people, don't touch. This is one you do not buy on the dip. We think Facebook is in the process of remaking their business model. You don't want to own big companies when they do that. On top of that, they're about to get hit with a ton of government regulation. Governments do have a habit of regulating businesses out of business. Apple, another one of our favorites. We had a long in there, the 180, 190 call spread in Apple, took profits. And by the way, I've been buying Apple since it was $4, which it fell to in the tech meltdown of 1986. So I have a long-term relationship with this stock. Our last buy was at 160. We rode all the way up to 230, got out at the top. We're now getting very strong buy signals to go back in. Coming in here at 165, maybe you have $5 of downside risk in Apple at this level, but $170 of upside potential over the next 3 years. So $5 versus 170. That sounds like a pretty good risk-reward ratio to me. I'd be buying Apple right here. Alphabet didn't really go anywhere last year. We did get the buy in April, got a nice 250-point rise on that, got out at the top. We're now getting the same buy signal that we got back in April. So yeah, maybe another 25% in this one, maybe more by Google. Amazon is a screaming buy. We're into Christmas retail season for a start, but there are a million other reasons. They're basically taking over the world. Oh, and they do almost no business in China, which means they're not part of the trade war drag that are hitting so many other stocks. Our last buy was at the beginning of 2018 at $1,200. Wrote it up just short of $2,200, got out. We're now putting in a strong buy recommendation here thanks to our market timing algorithm. Started buying at $1,450. We're still buying even at these levels. NVIDIA, another one of our favorites. We got into this 3 years ago when it was at $68. That was way back here. It's not even on the chart. Our last sell was in September when we thought the entire tech world was heading for a major sell-off, which we got. Stock's down nearly 50% from its all-time highs. Strong buy signals now. This company doesn't have a double in it. It has a triple or a quadruple on a 5-year view. They are the dominant graphic card manufacturer. Micron Technology, another one of our favorites. Again, got a major move there, about nearly 75% buying here, getting out here. We're now back into strong buy territory. And by the way, the earnings of this company is growing dramatically. So it's roughly 40% cheaper today than it was back at this low here in February. So again, this is how our market timing index works in these markets. Salesforce, another long-term favorite, another stock that has a double in it. We had a bull call spread in the options market on this, the 120, 125, and that was November, so it's already expired. We had a December. We took profits on that. We're in and out of this thing every month, playing from the long side only. We got out of a major position back here in September. We started going back here in this meltdown in November, and we've already made 2 round trips in the stock on this rebound. Industrials, you want to avoid. This is the sector that's given up all of its election gains of the last 2 years, and we don't want to touch this with a 10-foot pole. We'd rather be buying industries of the future rather than industries of the past. Tesla, this is the next $1 trillion company. It's only worth about $60 billion right now. We believe the shares will rise from 365 to maybe 2,500 or 3,000 over the next 10 years. I know Elon Musk well, been covering the company for 12 years, back when they were only making the 2-seat roadsters, which only had an 80-mile range. And the largest shareholders of this company all said they want to buy more stock. So Tesla 3 deliveries now up to 1,000 a week. I was at the factory last week picking up my new Tesla, and it's amazing. You see this giant parking lot fill up and then empty 3 times a day as people come to pick up their new cars and then go get their free factory tour. This is my newest Tesla. It's about 10 days old now. That's the Model X high performance P100D, 149,000, 162,000 with taxes in California. Has the 0 to 60 in 2.9 seconds, ludicrous mode. If you get one of these, make sure you come well stocked with airline airsick bags. Not everybody reacts well to going from 0 to 60 in 2.9 seconds, unless you're a former Marine combat pilot. This is my first Tesla. It was chassis number 125. I bought one of the first S1s coming off the assembly line. I was going to donate to the Smithsonian until a drunk driver driving a GM Silverado on Christmas Eve had other ideas. Completely totaled the car. A lot of people write about Tesla. Fewer people have visited the factory. How many do you know who's taken one apart? Yeah. Look at this honeycomb in the wheel wells. That's one of the reasons why it's the safest car in the world. And here's your 1,100-pound lithium-ion battery pack. In 10 years, that will weigh 10 pounds, but still get you a 300-mile range. Healthcare sector, another one of our major sectors we love for the long term. We participated in the spring with a buy signal here, got out at the top the end of September. Now we, perfect test of the 200-day moving average. Any more visits to the 200-day, I'd be a strong buyer of the healthcare sector. And by the way, one of the reasons this is down so much on Friday is because of Johnson & Johnson. There was a news story that there was asbestos in their baby powder, not good for marketing. No, stock got creamed down 10%, pulled the whole index down with it. So buy healthcare on the dip, take the gift from Johnson & Johnson. Goldman Sachs, the next buggy whip maker. We want to avoid the entire financial sector. Their lunch is getting eaten by small fintech companies like PayPal and Square. When you see a company like this, which should be going up with rising interest rate, and it goes down instead, that means there's something structurally wrong with the sector. Sell all your banks before they go to zero. Palo Alto Networks, hacking never goes out of fashion. This has been a favorite of ours for a year. We de-risked completely in September, as we did with all other stocks. We're now getting strong buy signals here. Hacking never goes out of fashion. Consumer discretionary, you don't want to go anywhere near because recession is going to happen sometime next year, and this is the worst hit sector in a recession. So Disney, I'll skip Amazon from this because it's not really a consumer discretionary stock, but McDonald's, Starbucks, all these things are going to weigh down the index. The only other exception would be Home Depot, which I'd buy at the beginning of the next hurricane season. It always seems to do well then. Bonds, we've had a major flight to safety. Huge global risk off created a flight to safety bid that took yields down 43 basis points to a 2.82% low. 3 more Fed rate hikes in 2019 after coming December Fed hike, which will happen on Wednesday this coming week. In a year, overnight rates will be at 3% to 3.25. If that doesn't cause a recession, nothing will. So much of the economy's gotten addicted to cheap money. We're about to find out who's been swimming without a swimsuit when the tide goes out. Interest payments are about to become the largest government expense within a decade at $900 billion a year, far outpacing the defense budget by 2028. Interest rates are now inverted. Short rates are higher than long ones. Exploding deficits will weigh heavily on bonds for the next decade. Sell every rally across the space. The deficit is up 100% in 2 years, and in November, we had the largest government budget deficit in history. Bottom line, sell every 4-point rally in the TLT. That'll be a great short selling opportunity. And by the way, we've just had a great 4-point rally and then another 4-point rally. We already sold short this top, took the profits on it, but I'd be an aggressive seller of something, a buyer of something like the 122, 125 call spread, put spread in January, February, and March. If you're an options player, if you're not, just short the TLT outright. This is going to be a great trade and has been a great trade for us for the last 2.5 years. You can see we sell every one of these rallies and laugh all the way to the bank. Here's the Treasury yield. So if you're shorting bonds, you're essentially buying the Treasury yield. And again, we bought every one of these dips, and we're a very aggressive buyer right here, right now, with the 10-year yield at 289. Energy just had the sell-off of the century. Oil got crushed on recession fears and a potential OPEC breakup, which would lead to chronic overproduction. Even Iran sanctions and the Saudi crisis aren't helping. U.S. infrastructure is still constrained on production expansion. It's going to take 10 years of investment for U.S. energy infrastructure to keep up with the fracking gas and oil that we're producing today. Copper is bouncing along 2-year lows, which is why the commodities in general are a no touch. Futures have gone from backwardation to contango. Bottom line, buy the bottom in the energy area. And this is what happens when your largest new consumer goes into recession. That's China. They are the largest marginal new buyer of oil in the world. And when your economy slows down, so is the price of oil. However, down here at $50, oil is a screaming buy. Another one of these $5 of downside, $50 of upside type trades. I'll do a 10-to-1 risk-reward ratio all day long. ExxonMobil, another one, and this one you get paid to wait with a 4.34% dividend. I'd be a buyer of Exxon right here. Energy Select Spider, also looking kind of struggling to make a head and shoulders bottom right here on the charts. That makes the energy stocks a buy, and the leaders there are Exxon, Chevron, Schlumberger, Kinder Morgan, ConocoPhillips, and so on. Copper, trade war fears are keeping it at a bottom. Any sign of a deal with China, you want to buy this with both hands. It will be the first to recover. Precious metals have gone back to sleep. Gold got a brief flight to safety bid and installed. Central banks have become the principal buyers of gold in 2018, some 264 metric tons. That is increasing. Russia and Turkey have been dominating, with Poland joining the fray. Bitcoin is also struggling at the bottom, seems pent on breaking to new lows. Bottom line, get ready to buy the next dip in gold. And you can see we started buying in September, partly as a hedge from a big overbought signal we were getting in the stock market. That worked, but not as well as we expected. And the reason is we haven't had real inflation yet. To really get gold off to the races, you need to see serious inflation. I mean, inflation prints of more than 3%. We'll see those in 2019, but not yet. Market Vector Gold Miner also putting in a long-term bottom here. This has basically been in a 7-year bear market. I like buying 7-year bear markets because they very rarely go to 8-year bear markets. So buy the gold miners here. Here's another one that we did buy at the bottom, Barrick Gold. It's the world's largest gold miner. And we just when we started buying gold, it was off the races for Barrick Gold, up about 50% from the low. That shows you how these trade alert timing things work. Real estate has been in a full-scale recession for a year now. October, existing home sales were up 1.4%, but new home sales were down a horrific 8.9% and off 12% year on year. Inventories are at a 9-year high. Median home prices are rising at 3.8%. That's the slowest gain in a year. Inventories rise to 4.3 months. Home builder confidence hits a 5-year low. S&P Case-Shiller dropped to 5.5%. That's the lowest gain in 18 months. However, fixed rate mortgages have dropped to 4.7. That's the steepest drop in 5 years on the back of the bond market rally. So, real estate, stand aside, sell your second home, deleverage as much as you can, get ready to start buying at the bankruptcy auctions in the next recession, as many did in the last recession. Here's your Case-Shiller. You can say after dramatic increases, the rate of increase of price increases is slowing down dramatically, and this is going to drop to 0 in coming months. Home Construction Index, one of the worst performers this year, still horrible, sitting at the bottom. That's a no touch. So what do we do about all this? Well, stocks, you want to buy the dips. Bonds, you want to sell any and all rallies. Commodities, stand aside. That's going to be a 2019 trade. When inflation comes back, currencies, stand aside. The dollar is still strong. Precious metals, buy the dips. Oil, buy the dips. Volatility, sell short those huge runs up to the mid-20s and then buy the dips after that. Real estate, you want to stand aside. So if you're not up 35.33% in the past 12 months as I am, you are reading the wrong newsletter or following the wrong trade mentoring service. And yes, I'm the last person in the stock market who still wears his suspenders. Daily trade performance. This is independently audited every day by an outside accounting firm. And you can see what the performance looks like. Basically, we try to make money in all market conditions where the market itself is going up, down, or sideways, and it works. If you think I was lucky this year, this is our 9-year average annualized return, 34.36%. Here's the very long view for financial markets. The 2000s, the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials will become the next big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. In the meantime, central banks will keep bridging the current demographic slowdown with aggressive monetary policy. And that is me at Zermatt, Switzerland, watching climbers come down from the Matterhorn. That's where I base myself every summer. Here is the Dow average from 1982 to 2000, up 20 times in 18 years. Are you ready for a replay? Yes, we all look like geniuses from 1982 to 2000 because the Dow went from 600 to 12,000. So what happens if we get the same 20-fold return that started in 2009? Well, up 20 times in 18 years takes us to 120,000 by 2027. Don't lose all your money now trading difficult markets when the easy money will be made in the 2020s. So who will show you how to play the next 90,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top trade mentoring service in the industry, up 35.33% in volatile markets. Follow my research and market-beating trade alerts, and you will rake the profits in. Let a Marine combat pilot steer you to big profits. And no, that is not the plane I flew in Desert Storm. Flying vintage aircraft has been one of my passions in life. This is a 1932 de Havilland Tiger Moth. Notice the design flaws: gas tank right over your head and no brakes. That's why you can only land this on a grass field. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical trading month for us. You can see in January, we bought the S&P 500, sold short treasuries, bought the Russell 2000, bought Amazon, bought Apple, bought Biogen. Oops, we stopped out of Biogen due to a certain presidential tweet. Took a 21% loss there, but then bounced right back, buying Palo Alto Networks, selling short the yen, selling short treasuries, buying the S&P 500, and buying gold. So again, about 9 out of every 10 trades make money, and we stop out of the losers very quickly. That's how the pros do it. That's how you should do it too. You wanted to buy the next technology dip? Here's the dip. Get a portfolio of the best quality, fastest growing tech stocks you absolutely have to buy right now. The resolution: with a 26% annual earnings growth rate, is just a matter of time before tech stocks break out to new all-time highs. Watch this space melt up going into the end of 2018 and into 2019. Get ready to start wheeling in those whoppers with the Global Trading Dispatch as your guide. And yes, that is a 24-inch trout, which I caught in Pyramid Lake in northern Nevada. Unfortunately, it's catch and release, no trophies. Here's how it works. We spotted a breakout coming in Micron Technology. The stock was then at $42.01. So we sent out a trade alert at Market Sweet Spot by text message and email. From the time I hit go to the time you get the trade alert is roughly 5 seconds. Buy Micron Technology at 42.01 or best. Opening trade. Here was the trade date. Portfolio weighting 10%. Number of shares for a $10,000 exposure, 238 shares. What did Micron Technology do? Well, we caught the, then it was a 25% move up. Actually 15.63% profit in 15 trading days. What did we do? Send out another trade alert saying take profits. Sell Micron Technology at 48.58 or best. It's a closing trade. There's the trade date. And the profit we made on this in 15 days was $1,563 That is not bad. Most of you will take that all day long. With my global trading dispatch service, you get a daily research letter, instant trade alerts sent out at market sweet spots, about 200 a year, and the reasons to execute them, live biweekly strategy webinars with a Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, more educational videos and webinars that you could consume in a lifetime, access to a 10-year database on investment ideas searchable by name, and I'll even give you the name of a good surfing camp in North Africa, which even has a seniors division. Warning, it is a lot harder than it looks. Here's what I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $10,000 a year. That's what I charge my concierge clients who get my personal cell number so I can act as their investment 911. And I'm not going to charge you $5,000. That's what I charge my advanced options trading clients, of which we have thousands. And I'm not going to charge you $3,000. That is the cheapest price on my website for 1 year of my service. This is the real deal. Creating this product cost me millions of dollars. With the best customer support in the industry, running it cost me millions more. Today and only through this webinar, you can get 3 months for just $497. We know when it comes to renew, you'll happily pay the full $3,000. And by the way, we don't auto bill. If you don't renew, that's up to you, but the decision is yours. So if you want to get this one-time only offer, which I'm only offering today because it's Christmas and we're having a pre-Christmas sale, just click on the chat box on the right. This is a limited time offer. I can only take 25 new subscribers at a time, so it's first come, first serve. I can't wait to make you a top drawer trader, and just click on the chat box on the right, and let's see, Janine, have you got the link in there? And you do. Thank you very much for that. So again, let me make the money for you to pay for your own subscription. You make the trades. And we'll go on to a few testimonials here, and I'll answer some of your questions. And I have a question from Bill in Bangor, Maine. Bonds have come down on a sudden flight to safety. The 30 years under 2.9%. Do you see yields going back in the short term? Absolutely, Bill. Yes. And that makes bonds a screaming short at this level, with the U.S. government about to crowd out all private borrowers with its own massive borrowing. That makes a very strong short for the U.S. Treasury market. Let's see. Here's an oil question from Jim in Houston, Texas. Will the cut in OPEC supply stem the spiraling down of oil prices? Is there a trade in this? Well, the answer to both questions is yes. It will stop the downturn, and there is a great trade on the long side. OPEC roughly cut their production in the last meeting by 10%. As long as they don't cheat too much, this should push prices up over the short, medium term. Here we have Mary in Portland, Oregon. Do you see an American recession by the end of 2019? Absolutely yes, and that's why we're calling a top in the stock market in March of 2019. Stock markets usually anticipate recessions by 6 to 9 months. Okay, Bill in Portland, Oregon, can we talk to you directly? The answer, Bill, is yes. I spend part of every day calling readers and looking for ways to improve the service. You can email me anytime, and I always answer same day. You also get a chat box at each of my bi-weekly strategy webinars like this one, where you can ask all the questions you want. A lot of questions here. Let me just go through them. Jim in Dallas, Texas. Are the trade alerts for stocks, ETFs, or options? Jim, every trade alert we send out has an alert for all three, a stock, an ETF, or an option. We want to send out a range of possible securities with every alert so readers can tailor it to their specific needs and risk-taking profile. Joe in Detroit, Michigan. I've never done this before. Can a beginner start with no prior experience? Absolutely, Joe. Bringing beginners into the market for the first time is one of the primary goals of this service. I love doing it. Joel in New York City, how often is the newsletter sent out? Joel, we send it out every day the market is open, about 250 times a year, and every letter will have 2 or 3 trading ideas. Okay, here's a question on the dollar. Is the strong dollar over? I would say no. With the market rallying and interest rates falling, it's only taking a rest. Strong dollar will resume when the bond market collapses once again, which it should do imminently. Okay, a couple more questions, and I've got about 15 more minutes. Let's go through this. Will the Chinese allow the yuan to collapse to fuel exports and stimulate their own economy? The answer is yes. Since the trade war started, the yuan has gone down about 10%. That has completely offset the entire 10% tariff for American buyers. And if we raise our tariffs to 25%, as the president has threatened from January 1st, then you can expect another 25%, another 15% depreciation in the Chinese currency. Question here from Lee in Hong Kong. Why won't banks benefit in a rising interest rate environment? Well, for a start, while interest rates have been rising, loan volumes have been falling off a cliff. That's partly because of sharply increased loan standards, which makes it a lot harder to get a loan. If you run a small business like I do, you know how hard it is to get a bank loan these days. But also banks, like I said earlier, are in the buggy whip making business. Their business model is dying. All these giant branch networks you see around the country will disappear in 10 years because nobody can afford them. And let me go on to another testimonial, and this is me again at Zermatt in front of the Matterhorn. I spend about 4 months a year at Lake Tahoe, where I have another house, and that's me hiking in the spring above Incline Village. I'll keep going on with the questions here. John in Kansas City, Missouri, will geopolitics drive the market more than it did in 2018? The answer is yes. It seems like Washington is blowing up. There are nightmare headlines coming out every day. This is not engendering confidence among stock investors. As long as the stock market was going up, people were happy to ignore this. But for the last 2 months, stocks have not been going up, and the focus on Washington is greatly increased. This will go away, but I think with all the trade wars going on, I think the geopolitical backdrop for the market will get worse. Okay, Roger in Richmond, Virginia, do you offer training with a subscription? Yes, Roger. Every trade alert that goes out has a link to a video that shows you exactly how to execute this trade alert on your own online trading platform. We want as many people to execute these trade alerts as possible because we know if they make a lot of money, they will renew. We have a renewal rate of about 80%. The other 20% either retire or they die. Okay, George in Austin, Texas, when does your newsletter come out every day? George, goes out about midnight Eastern every day. It'll be right in your inbox before every market opening, so you can place those orders before the market starts. Okay, Justin in Chicago, is there any scenario you see stocks rising by 10% next year? Answer, no. Justin, you're really asking me, are we going to get an 11th year in this bull market? And I would say no. You know, with rising interest rate, rising oil prices from here, falling corporate earnings, rising political instability, and a market that has had a great 10-year run, I would say it's time for a rest. When we do get a bear market, by the way, it'll be a very short one, probably only about a year. Although it doesn't feel like it, the last bear market only lasted 18 months. Traditionally, bear markets only last 6 to 12 months, and there are great opportunities to be had there on the short side. Okay, moving on to more questions. Let's see. Jim in Palo Alto, California. Are you an algorithm? No, but if I knew a good machine noise, I would make one right now. Come to one of my strategy lunches. You can pinch me, and if I bleed, you'll know I'm real. Of course, you might also get a punch in the nose. I am an ex-Marine. Actually, you're never an ex-Marine. You're a Marine for life. So I would adopt that strategy with some caution. Ivan in Portland, Oregon. Here's a good question. How would you describe your trading philosophy? Ivan, I use fundamentals for my long-term call and technicals for my short-term execution. This is what every long-term professional does, and it's what you should do too. Notice that there are no purely technical analysis hedge funds in existence. That's because if you only rely on technical analysis, you will lose money. It can't be relied on over the long term. I say this because I know a lot of you beginners who are fresh to the market rely a lot on technical analysis. And if you eliminate the word if from technical analysis, it has absolutely nothing to say. You know, if it goes higher, it'll go higher. If it goes low, it'll go lower. That's basically what 99% of all technical analysis is. Okay, looking for more questions here, and I got about another 5 minutes to go. What are your thoughts on Uber, Lyft, and Airbnb? I hear they're all going public next year. Should I get involved? Henry in San Francisco is asking, and the answer is no. Don't touch any of these. They all have a nasty habit of falling 50% after all the hype of the initial public offering. Buy them down 50%. That's what I did with Tesla. Tesla came out at $30 a share. I got it at 16.5. It's now at $3.65. So yeah, avoid the Wall Street hype. It'll cost you a fortune, probably stop you out at the bottom. These are all great companies. And by the way, there's a race going on in particular between Uber and Lyft to see who can be first to the market and get the highest premium for their stock. You don't want to be paying the highest premium for their stock. I never touch the IPO market. I always wait for the meltdown that follows, and that's where you get your real bargains. Okay, a couple more questions here. Just let me scroll through. Here's a nice one. You obviously have enough money. Why are you doing this? Well, teaching people how to make money and secure their financial future is the love of my life. When I was on Wall Street, I used to see so many people getting ripped off by brokers that it made me sick. This is the chance to level the playing field for the regular guy. This is me playing with some real black swans in New Zealand, and I'll move on because we're running out of time. I got time for maybe a couple of more questions. Let's see, we covered, let's see, I bought GE at 17 thinking it was the bottom. It wasn't. It dropped to 6.5, now trading in the 7s. What should I do? Asked Nigel in Birmingham, Alabama. Nigel, it's too late to sell. If you've taken the hit, from now on, I think GE will recover, and I would not be a seller here. Hang on. Looks like they have decent management in place. May take a year or two to see results. So I would not sell your GE stock. Okay, there's me at the London Stock Exchange. We have one more testimonial there. And I'll take one more question. That'll be pretty much it to the day. Okay, just let me scroll through, get some good ones. Okay, covered that. Okay, Well, I think we're just about done for the day. That's me at Lake Tahoe. I snowshoe around it once a year. That's about 160 miles. That's where I get all my good trading hills, is when I'm snowshoeing uphill. And that's me in front of the model Tesla before the S1 was actually introduced about 8 years ago. So if you subscribe today, you'll get a copy of my free book, Stocks to Buy for the Coming Roaring 20s, in the store now for $49. We'll give it to you for nothing. The only caution is that several of the stocks in here have already doubled. Buy before the next double. If you click on the link on the chat box on the right, it'll take you to a dedicated sales page, only good for this webinar, 3 months for $497, or you can wait and go to my website and buy the service for $3,000 for a year. You also buy today, you will get an immediate trade alert with an extremely high probability of success, which you can execute at the Monday morning opening. I executed this trade myself at the Friday close on that final meltdown towards the end, and I am extremely confident it will make money. Subscribe to our service for $497. You can have that trade alert in your inbox instantly. So that's pretty much it for today. Today, only through this webinar, 3 months for just $497. I never give it away this cheap. It's only because I'm in a Christmas mood. And by the way, I've had a really fantastic year along with all of our followers that I'm willing to make this offer. Let me show you how to make the money to pay for your own subscription. 90% of our followers pay for their entire subscription for the year on just the first trade. If you have any more questions, just email me at support@madhedgefundtrader.com. Click on the box on the right to get to the dedicated sales page. And Janine, how are we doing on time?
Hey, Mad Hedge Fund, we're doing good. Can go wrap it.
Okay, do we have time for any more questions, or do you want to take it over from here?
You have about 4 minutes if you want to take them. They're yours.
Okay, let me go through the questions that have come in. Here's one here. What stock would you buy right now, right here? Well, the stock I would buy right now, right here, is the trade alert you would get if you buy the subscription. I'll tell you the number 2 stock I would buy, which is not in the trade alert, and that would be Amazon. We think Amazon is worth a minimum of $2,200 a share. We think if they break up Amazon in the next 5 years, which is highly likely, the breakup pieces will be worth about $3,000 a share. So here in the high 1500s, it makes Amazon an absolutely screaming buy. By the way, that's why they created a second headquarters in Long Island, New York, is to anticipate the spin-off of their major businesses, separating out the retail business from the cloud business, the food business, the healthcare business, and so on. So yeah, buy Amazon. It's just had a massive 30% sell-off. This is a rare entry point for a great stock. Here's another question here. How many hours do you work a day? Well, I work a lot. You know, first of all, I don't consider it work. This is my retirement, and I love what I do. And as long as you do what you love, it's not work. It's never work. And from that point of view, I haven't worked a day in my life. Having said all that, I wake up about 5 in the morning on the West Coast. We have to wake up early out here to catch the New York opening. And I usually work till about 5 or 6 at night. Then I put on a 60-pound pack, head out my back door, and do a 10-mile hike in the mountains outside of San Francisco. That is my healthcare plan. Hiking 40 to 50 miles a week keeps me young, keeps me thinking of those great trading ideas. Okay, and I'm just scrolling through here looking for more questions, see if we've missed any. Covered interest rates, covered recessions, covered China. Will the market hold the February lows? Well, that's kind of a good question because we actually did break the February lows on Friday. And what this market does is it breaks lows, sucks in a ton of selling, of short selling. Then the algorithms jump in, take it right back in up again, force those shorts to cover, and then that creates the next up leg in the market. So be ready for that. The final bottom in this market probably is only on Monday or sometime in the coming week. After that, we rally strong into the new year for all of the reasons I have given you. So again, to get this one-time only offer, click on the chat box on the right. And with that, Janine, I will hand it over to you.
Here at TradeThirsty, we do this every month on a Saturday, and today's the Saturday that we're doing it. And there's his link, madhedgefundtrader.com/TTT. Alrighty. Okay, so we've been through 2 presenters. We have 2 left. Our next presenter is with NetPicks, and his name is Mike Rixey. And I'm going to put his picture up real quick for you. There it is. Right before we turn the mic over to him, I'm going to go ahead with another trivia question. Are y'all ready? This one's worth $100. I'm only going to ask for the initials of this because it might take you long to type it. We just get right to it.